Gainers and losers lists are standard market scanners built into almost every brokerage platform because they compress a large universe of stocks into a short list of statistically significant movers. This helps traders identify opportunity quickly without manually screening thousands of symbols. Every major platform, such as Robinhood, Charles Schwab Fidelity Investments, and Interactive Brokers, includes them for several operational reasons. First, they highlight relative price movement. Gainers show the largest percentage increases over a defined time frame, usually daily, while losers show the largest decreases. Percentage change is more meaningful than raw price movement because it normalizes across different stock prices. Second, they surface volatility, which is where short-term trading opportunities tend to exist. Stocks that barely move intraday rarely offer day trading setups. Large movers often coincide with catalysts such as earnings releases, news, analyst upgrades, or unusual volume. Third, they identify liquidity clustering. When a stock appears on a top gainers list, it often attracts additional participants. That self-reinforcing behavior increases volume, tightens spreads, and makes execution easier. Brokerages prioritize showing these because liquid markets reduce slippage risk for users. Fourth, they act as a market sentiment gauge. If most top gainers are in one sector, for example, semiconductors or biotech, it signals sector rotation. If losers dominate high beta stocks, it may indicate risk-off behavior. Traders use this to align with broader momentum. Fifth, they improve workflow efficiency. Instead of running complex scanners, traders can immediately start with a curated shortlist. Many day traders build their entire morning watch list from pre-market gainers, then refine by float, news, and volume. Finally, they drive platform engagement. These lists are dynamic and constantly updating, which encourages users to monitor markets more actively. From a brokerage perspective, this increases usage without requiring advanced technical knowledge. In practice, gainers, momentum candidates; losers, potential reversals, short setups, or oversold bounces. Both equal starting point, not a complete trading decision. Most experienced traders treat them as discovery tools, then apply filters such as volume, news catalysts, float size, and key levels before trading. Day trading gainers and losers lists has several structural advantages. These lists concentrate volatility, liquidity, and attention, three variables that directly affect intraday opportunity. Stocks appearing there are already demonstrating range expansion, which reduces the need to predict movement. You are reacting to confirm momentum rather than anticipating it. Key positives: high volatility, larger intraday ranges and clearer setups, elevated volume, tighter spreads, and faster fills. News catalysts, directional conviction and follow-through. Crowd participation, self-reinforcing momentum. Efficient scanning, faster watchlist building. Clean technical levels, breakouts and pullbacks behave more reliably. Top strategies commonly used with gainers losers. 1. Opening range breakout, momentum continuation. You identify the high and low of the first 5-15 minutes after the open. When a top gainer breaks above the range with volume, traders enter expecting continuation. This works well because gainers often already have pre-market momentum. Risk is defined below the range. 2. Pullback to VWAP trend continuation. Strong gainers often trend above VWAP. Traders wait for the first controlled pullback to VWAP or the 9 EMA, then enter when buyers step back in. This avoids chasing extended moves and improves risk reward. 3. High of day break strategy. After the initial spike, gainers frequently consolidate and then attempt new highs. Traders buy the break of the prior high with increasing volume. This is effective when float is small and momentum traders pile in. 4. Gap and go, pre-market gainer continuation. Stocks that gap up and appear on pre-market gainers often continue after the open. Traders look for strong pre-market volume, hold above pre-market high, then enter on breakout. Works best with news catalysts. 5. Fade mean reversion for losers or overextended gainers. Not all movers continue. If a stock is extremely extended and volume starts declining, traders short the parabolic move or buy oversold losers for a bounce. This requires experience. Risk control is critical. 6. Volume spike breakout. When a gainer consolidates and suddenly prints a large volume bar, traders enter expecting expansion. The idea is that institutions are stepping in. 7. First pullback after parabolic move. After a strong vertical run, the first orderly pullback often produces another leg. Traders wait for higher low formation and re-entry. Typical workflow used by many intraday traders. Pre-market, scan gainers, losers, filter, volume, float news, mark pre-market highs, lows. Wait, first setup, breakout or pullback. Execute with defined risk, scale into continuation. Gainers generally favor momentum continuation strategies. Losers generally favor bounce or short continuation strategies. Most consistent approach for many traders, opening range breakout plus VP pullback combination. This pairing captures both early momentum and safer entries after confirmation. Using opening range breakout ORB specifically on gainers and losers focuses on exploiting early session price discovery. Stocks on these lists already exhibit abnormal volatility, which increases the probability that the opening range will lead to continuation rather than chop. Definition: the opening range is the high and low formed during the first fixed interval after the market opens, commonly 1, 5, or 15 minutes. A breakout occurs when price moves beyond that range with volume expansion. On gainers, traders typically take upside breaks. On losers, they look for downside breaks. Why ORB works better on gainers, losers? First, these stocks already have catalysts, so directional bias exists. Second, volume is concentrated early, which reduces false breakouts. Third, crowd attention amplifies moves when key levels break. Fourth, volatility creates sufficient range to define risk clearly. Step-by-step process, gainers. Before the open, identify stocks up significantly with high pre-market volume. Mark pre-market high and low. At the open, allow the first 5 minutes to form. Draw the opening range high and low. If price breaks above the high with increasing volume, enter long. Place stop below the opening range low or midpoint depending on risk tolerance. First target is typically 1R. Second target often prior resistance or whole dollar levels. Step-by-step process, losers. Select stocks down significantly with negative catalysts. Wait for the opening range. When price breaks below the range low with volume, enter short. Stop goes above range high. Targets include previous support levels or measured move equal to the opening range size. Time frame selection. 1 minute ORB, fastest, more signals, higher false breakout rate. 5 minute ORB, most commonly used, balance of reliability and opportunity. 15 minute ORB, fewer trades, stronger confirmation, suited for calmer execution. Volume confirmation. Breakouts without volume tend to fail. Ideal ORB breakout shows expanding relative volume compared to earlier bars. Many traders require the breakout candle to have the highest volume in the opening range. Risk management structure. Entry, break of range. Stop, opposite side of range or just inside range. Target, 1-2 times the range size. This creates a defined risk-to-reward framework. Common variations. Half-range entry. Enter when price clears midpoint and shows momentum. Retest entry. Wait for a breakout, then enter on pullback to range high. Delayed ORB, ignore first move and trade second breakout after consolidation. Key filters for better trades. High relative volume, clear news catalyst, low to medium float moves faster, tight spread, alignment with overall market direction, strong pre-market trend. Common mistakes. Entering before range is fully formed. Trading low volume symbols. Chasing extended breakout candles. Ignoring broader market trend. Using too tight stops inside noise. Best scenario for gainers. Gap up plus strong pre-market trends holds above VWAP's ORB breakout. Best scenario for losers. Gap down, weak bounce, rejection at VWAP ORB breakdown. Typical trade logic. Gainer, momentum continuation. Loser, breakdown continuation or weak bounce then breakdown. Many traders combine ORB with VWAP. Breakout above range and above VWAP equals a stronger long bias. Breakdown below range and below VWAP equals stronger short bias. Adding a dollar volume, $100 million filter to gainers losers before applying an opening range breakout materially improves trade quality. Dollar volume measures capital flow, not just share turnover. It removes illiquid names that produce unreliable breakouts. Definition: dollar volume equals price volume. It reflects how much money is actually being traded, which correlates with liquidity and institutional participation. Why $100 million is a useful threshold. Below this level, spreads widen and slippage increases. Moves are often retail-driven and prone to reversals. Above this level, order books deepen, fills improve, and breakouts tend to follow through. In practical terms, It filters out thin stocks that look attractive but cannot sustain momentum. How it improves ORB specifically. First, it reduces false breakouts. High dollar volume means more participants defending levels. Second, it improves execution. Stops and entries feel closer to intended prices. Third, it increases trend persistence. Large capital flows tend to continue rather than reverse abruptly. Typical filtering workflow. Pre-market. Scan gainers, losers. Apply filters. Price range, for example, $220 or $5 to $100 depending on style. Relative volume, dollar volume 100 malers, catalyst news. Then mark opening range and wait for breakout. Interpreting different dollar volume tiers. $20 50 mems, low liquidity, high risk of fake moves. 50 mem $100, tradable but inconsistent. 100 mem to 300 mems, optimal for many intraday traders. 300 mem liquid, slower but more reliable. 1B plus institutional level liquidity, moves may be steadier but less explosive. Example logic for gainers. Stock up 25%, high relative volume, dollar volume $150. This suggests meaningful capital inflow. ORB breakout above range has higher probability of continuation. Example logic for losers. Stock down 18%, dollar volume $200. This indicates strong selling pressure. ORB breakdown below range likely to extend downward. Best combination for consistency. Top gainer loser plus clear catalyst plus dollar volume $100 plus 5-minute ORB plus volume expansion on breakout. This approach narrows the watch list to fewer but higher quality setups.